Ever feel like small banks are being overlooked in today's market? At Insightful Value, we hunt for exactly these kinds of under-the-radar opportunities, and today we're looking at Flushing Bank, whose stock price has taken a hit, but could that be exactly what makes it interesting? This review is for informational and educational purposes only. It is not financial advice. If you appreciate sharp insights into overlooked companies, make sure to like this video and subscribe to the channel. Flushing Bank, operated by Flushing Financial Corporation, is a regional bank based in Uniondale, New York, with roots going back to 1929. It serves consumers and businesses primarily in the New York metropolitan area, with a focus on Queens, Brooklyn, Manhattan, and Long Island. Their business model includes traditional banking services like checking and savings accounts, commercial real estate loans, residential mortgages, and small business lending. They also offer digital banking and cash management solutions for businesses. So, why has the stock been trading at depressed levels? Like many regional banks in 2023 and 2024, Flushing has been hit by rising funding costs, pressure on net interest margins, and investor skepticism following last year's regional bank turmoil. In its most recent financials, Flushing reported a year-over-year drop in net income, with margins narrowing due to the higher interest rate environment. The net interest margin has dipped below 2.5%, which is challenging for profitability. Earnings have been under pressure, and return on equity has also declined compared to previous years. Despite the headwinds, the bank maintains a solid capital position, and its credit quality has remained relatively stable. The percentage of non-performing assets is low, and loan delinquencies haven't shown any major spikes. Their loan portfolio is heavily weighted toward commercial real estate, particularly in New York, which poses both an opportunity and a risk depending on how that market evolves. That's a key factor for any investor to monitor. Flushing has been paying dividends consistently. In 2024, the dividend yield remains attractive, over 6% at current prices. However, the payout ratio has crept higher, raising questions about long-term sustainability if earnings don't recover. Still, for income-focused investors who believe regional banks will rebound, that yield is hard to ignore. The risk: regional banks like Flushing remain vulnerable to interest rate fluctuations, credit tightening, and changes in local real estate trends. If the Federal Reserve holds rates higher for longer, it could squeeze Flushing's margins even more. On the flip side, if the rate cycle turns, the bank's earnings power could bounce back. From a valuation perspective, Flushing is now trading below its book value and well below historical averages on price to earnings. This discount reflects the uncertainty, but could offer an upside if the bank stabilizes its margins and returns to earnings growth. At Insightful Value, we bring you deep dives into undervalued stocks like Flushing Bank. We simplify the data, strip out the noise, and highlight what really matters for value-focused investors. Whether you're new to investing or a seasoned pro, our goal is to make smart investing easier and more insightful. For more breakdowns like this, head over to insightfulvalue.com. Don't forget to subscribe and hit that like button so you stay in the loop with our latest stock insights.